17 trillion. That's how much wealth American households lost during the Great Depression from 1929 to 1933. Stocks crashed 89%, 10,000 banks vanished. 1 in 4 people couldn't find work. An entire generation wiped out financially. Now, here's what should keep you awake at night. What we're facing right now in 2026 isn't just similar to that nightmare. It's actually worse. And I'm about to prove it to you with 4 numbers that Wall Street desperately hopes you'll never see. The total debt in the American system right now, the 98 trillion. And that's not just government debt. That's everything. Government, corporate, household, financial sector, all of it, $98 trillion. Back in 1929, total debt was $290 billion in today's dollars. Stop and think about that. We have 337 times more debt today than we had when the Great Depression started. 337 times. But here's where it gets truly terrifying. In 1929, when debt went bad, it stayed local. A bank collapsed in Iowa. It didn't automatically destroy a bank in New York. Today, everything is wired together through derivatives, through digital markets, through a global financial web. When this system breaks, and it will break, there's nowhere to run, nowhere to hide. And it's not breaking in just one place like it did back then when stocks collapsed. No, it's breaking everywhere at once. Stocks, bonds, real estate, and the dollar itself. All of them. Simultaneously, I'm going to reveal the exact 4-stage pattern that has destroyed every major civilization throughout history. Then I'm going to show you where we are right now in 2026. And once you see this pattern laid out clearly, you'll understand this isn't just my opinion. This is mathematics. Cold. Predictable. Unstoppable. And we're not heading toward the crisis anymore. We're already trapped inside it. Here's the pattern. 4 stages. Fixed, chronological, unchangeable. Every single debt crisis in recorded history has followed this exact sequence. No exceptions, and once you understand how it works, you'll see why 2026 cannot escape it. Stage 1, the foundation. An economy builds on real productive growth, actual output, sound money. Debt exists, sure, but it's backed by the genuine ability to repay through real economic activity. Credit finances actual investment. Farms, factories, infrastructure, businesses that create real returns. The foundation is legitimate wealth creation. Debt serves production. This is the earning phase where things actually work. Stage 2, the expansion. This is where it gets dangerous. Credit becomes easier. Lending standards start dropping. Debt grows faster than the economy. The gap between what's owed and what can actually be repaid starts widening. But everyone's making money, so nobody questions it. Asset prices inflate, stocks go up. Real estate goes up. People feel wealthy. So they borrow more against those inflated assets. Banks lend more because collateral values keep rising. This creates something deadly, a self-reinforcing cycle. More debt pushes asset prices higher. Higher prices justify even more debt. And here's the mechanism that makes it impossible to stop. The financial system itself becomes addicted to credit expansion. Banks earn fees on every loan. Investors earn returns on appreciating assets. Workers get jobs in finance and real estate. Politicians collect tax revenue from transactions and capital gains. Stopping the debt growth becomes politically and economically impossible. The entire system is now built on one dangerous assumption that credit will keep expanding forever. Stage 3, the crisis trigger. Something breaks the cycle. It doesn't have to be dramatic. A regulatory change, a foreign shock, a shift in market sentiment. Suddenly, the weakest borrowers can't get new loans to pay off old loans. Defaults start small. A few banks, one sector. But because the system is so interconnected and so leveraged, the defaults spread like wildfire. Asset prices stop rising. Then they start falling. Falling prices mean collateral is worth less. Less collateral means banks demand repayment or refuse new loans. Borrowers are forced to sell assets to raise cash. Forced selling pushes prices down even further. The self-reinforcing cycle that drove everything up, it now drives everything down. Fear replaces greed. Cash hoarding replaces lending. Liquidity vanishes like water in a drought. And here's the critical insight that most people miss: the debt doesn't disappear. Every dollar of debt is someone else's asset. When borrowers default, lenders lose. When lenders lose, they cut lending. When lending stops, the economy contracts. Contraction means less income. Less income means more defaults. The feedback loop becomes unstoppable once it starts. There's no brake pedal anymore. Stage 4, the destruction. The system resets violently. Debts get wiped out through default, through inflation, or through both happening at once. Asset prices collapse to levels that actually reflect real economic output, not inflated fantasies. Wealth concentrates dramatically. Those holding hard assets and cash survive. Those holding inflated paper assets and debt get obliterated. The middle class, holding their wealth in stocks, bonds, and real estate, gets annihilated. The economy shrinks, unemployment explodes, social unrest follows, and eventually, after years of grinding pain, the system stabilizes at a much lower level of debt and economic activity. Then the cycle starts again because human nature never changes. We forget, we repeat. 4 stages. Foundation, expansion, crisis, trigger, destruction. This has happened dozens of times throughout history. And every single time, people in stage 2 believe it's different. They believe the expansion can continue forever. They're always wrong. Always. Let me prove it to you. The Great Depression, 1929 to 1933. Stage 1 was the 1920s foundation. Real economic growth coming out of World War I. Industrial production rising. The foundation was solid and real. But then came stage 2. Credit expansion went completely insane. Margin debt on stocks reached levels never seen before. You could buy stocks with just 10% down, 9% borrowed. Everyone was doing it. It seemed like free money. Stock prices tripled from 1925 to 1929. Price to earnings ratios hit 30 and kept climbing. Speculation replaced investment. Florida real estate bubble. Get rich quick schemes everywhere. The roaring 20s. But underneath the glamour, the debt was piling up. Corporate debt, household debt, margin debt, farm debt from overexpansion during the war. The entire economy was leveraged to asset prices that had completely disconnected from reality. Stage 3 hit on October 24, 1929. Black Thursday. The trigger was simple margin calls when stock prices started falling. Brokers demanded more cash to cover loans. Investors didn't have cash. They had stocks bought with borrowed money, so they sold stocks to raise cash. Selling pushed prices down. Lower prices triggered more margin calls, more forced selling. The feedback loop kicked in with devastating speed. Within days, panic set in. October 29th, Black Tuesday, 60 million shares traded, losses of 14 billion in a single day. That's over 200 billion in today's money. But worse was yet to come. Stage 4 lasted 4 brutal years. From October 1929 to the bottom in 1933, the Dow Jones fell 89%. Peak of 381 down to 41, 9,000 banks failed. Think about that number, 9,000. 1/3 of all banks in America just gone. Depositors lost everything. No FDC insurance existed yet. GDP collapsed 27%. Unemployment hit 25% officially. Real unemployment was closer to 35% when you count people who gave up looking for work. Breadlines stretched around blocks. Hoovervilles sprouted in every city. Farmers lost their land. Middle-class families destroyed. Suicides spiked. The social fabric tore apart. Wealth concentration accelerated dramatically. The richest got even richer, buying assets at pennies on the dollar. Everyone else got obliterated, verified. All 4 stages played out with mechanical precision, like clockwork. Now let me show you a faster example, one that proves speed doesn't save you. The Weimar Republic, 1921 to 1923. Stage 1, Germany had been an industrial powerhouse. Strong economy, sound currency backed by gold, real productive capacity. That was the foundation. Stage 2 started after World War I, Treaty of Versailles. Germany owed 132 billion gold marks in reparations. Impossible to pay through taxation alone. So they printed money. The Reichsbank started expanding the money supply to pay government obligations. At first slowly, then faster. By 1922, the printing accelerated dramatically. The exchange rate went from 320 marks per dollar to 400 marks per dollar in just 6 months. But most Germans didn't panic yet. They still believed it would stabilize. Wages were going up. People felt okay. That's stage 2. The expansion phase where the problem is clearly visible, but everyone assumes it will somehow resolve itself. Stage 3 arrived in January 1923. France and Belgium invaded the Ruhr Valley, Germany's industrial heartland. Germany responded with passive resistance, told 2 million workers to strike but kept paying them with printed money. The printing press went into absolute overdrive. The exchange rate exploded. June 1923, 192,000 marks per dollar. October, 170 billion marks per dollar. November, 4.2 trillion marks per dollar, 4.2 trillion. Stage 4 was total annihilation. A loaf of bread cost 160 marks in December 1922. By September 1923. By November, 200 billion marks. People needed wheelbarrows full of cash to buy groceries. Workers got paid twice daily and ran to spend it before prices rose again. Pensions became worthless overnight. Life savings evaporated in weeks. Anyone holding cash or bonds denominated in marks was destroyed. Anyone holding land, gold, foreign currency, or real assets survived. The wealth transfer was instant and complete. Middle class annihilated in less than 2 years. November 15, 1923, the government introduced the rent mark. 1 rent mark equaled 1 trillion old marks. The old currency became wallpaper. Literally, people burned it for heat because it was cheaper than buying firewood. Verified 4 stages, 2 years from start to complete destruction. One more example to lock this pattern in your mind forever. Japan 1989 to 2003. Stage 1. Japan in the 1950s through 1970s. Real economic growth, manufacturing powerhouse, productive investment, sound foundation. Stage 2, the 1980s. Credit expansion on absolute steroids. Bank lending grew 15% annually. Real estate prices went parabolic. The land under the Imperial Palace in Tokyo was valued higher than all of California. Think about that. One palace worth more than an entire state. Stock market tripled. The Nikkei went from 10,000 in 1985 to 38,900 by December 1989. Price-to-earnings ratios hit 60 and above. Everyone believed Japanese real estate and stocks could only go up. It was a national consensus. Banks lent against inflate operations, speculated with cheap credit. Debt to GDP went from 120% to 240%. Stage 3, December 1989. The Bank of Japan raised interest rates to cool the bubble. That was the trigger. Stock market peaked on December 29th, then collapsed. Real estate followed. Forced selling began. Collateral values dropped. Banks faced massive losses on loans backed by suddenly worthless real estate. They stopped lending. Credit froze. Stage 4 last decades. The Nikkei fell from 38,900 to 7,600, an 80% drawdown. Real estate fell 70%. Banks failed. The government tried everything: bailouts, stimulus, zero interest rates. Nothing worked. The debt overhang was too massive. Japan spent 3 decades in economic stagnation. The lost decades. The wealth destruction was enormous and permanent. Verified. Same 4 stages. Different country, same outcome. 3 examples. Different countries. Different triggers. Identical pattern. Foundation, expansion, crisis, trigger, destruction. The mechanism is universal. It doesn't care about culture, technology, or policy. It only cares about math. Now let me show you where America is right now in 2026, and why this time is worse than all previous examples combined. Stage 1 complete. America's foundation was real. Post-World War II industrial dominance. Bretton Woods gold standard. Productive economy, trade surpluses, real wealth creation. That foundation existed through the 1950s and 60s. Check. Stage 2, we've been here since 1971. When Nixon closed the gold window, all constraints on debt creation vanished. Completely gone. Total credit market debt was $2 trillion in 1971. Today, the $98 trillion, that's 49 times higher. That's not inflation, that's exponential debt expansion. Look at the components. Federal government debt $1 trillion in 1980. Today, your household debt at $1.3 trillion in 1980. Today, $17.5 trillion, corporate debt $1 trillion in 1980. Today, at $12.5 trillion, financial sector debt exploded from the trillion to over $30 trillion. Every crisis since 1971 was solved the same way. More lower rates, more stimulus 2001 recession, rates to 1% housing bubble, 2008 crisis, rates to zero, quantitative easing, $400 trillion Fed balance sheet, 2020 COVID, negative real rates, $6 trillion printed in 18 months. Fed balance sheet hit $9 trillion at peak. M2 money supply surged 40% in 2 years. Every single intervention created more debt and more asset price inflation. Stock market hit all-time highs. Real estate hit all-time highs. Bond prices hit all-time highs as yields hit all-time lows. Everything inflated simultaneously. And here's the trap that nobody talks about. The entire economy is now completely dependent on asset price inflation. Pension funds need 7% returns to meet obligations. They're allocated 60% stocks, 40% bonds. Retirees depend on stock portfolios for income. Banks hold trillions in mortgage-backed securities and treasuries. State governments depend on capital gains taxes. The financial sector represents 30% of S&P 500 profits. If asset prices fall, the whole system collapses immediately. So rates must stay low. Credit must keep expanding. No choice. But this creates the mother of all bubbles. Total household wealth hit $163 trillion in 2024, up from $60 trillion in 2000. That's asset inflation, not real wealth creation. The gap between asset prices and economic fundamentals is the widest in recorded history. Shiller PE ratio above 35. Housing prices 6 times median income versus 3 times historically. Bond yields near zero despite massive government deficits. Every asset class is in a bubble simultaneously. Stage 2. Complete verified. Stage 3. We're here now. Right now. The crisis triggers are hitting simultaneously. Multiple triggers at once. Let me show you exactly what's happening. Trigger 1, interest rates. The Fed hiked rates from no percent to 5.33% in just 18 months. Fastest hiking cycle since the 1980s. This breaks the debt service math completely. Federal government is now paying over $1 trillion per year just in interest. Corporate debt is facing refinancing at 5% to 7% versus 2% to 3% when it was issued. Commercial real estate can't refinance at current rates. Regional banks are sitting on hundreds of billions in unrealized losses on bond portfolios. Rising rates destroyed the business model built on free money. Trigger 2, reverse repo facility. This is the Fed's liquidity buffer. It peaked at $2.5 trillion in mid-2022. By January 2026, under $200 billion. This means money market funds have nowhere safe to park cash anymore. They're being forced into riskier assets or accepting lower yields. When this hits zero, the liquidity crisis begins. We're weeks away, maybe days. Trigger 3, Japan. The Bank of Japan is hiking rates to save the yen. This forces the unwind of the yen carry trade. Estimated $1.1 trillion was borrowed in yen at 2% and invested in U.S. assets. As Japanese rates rise and the yen strengthens, this trade reverses. Borrowed yen must be repaid. U.S. assets must be sold. $1 trillion in forced selling hitting markets. Already starting to trigger China selling treasuries. China held $1.3 trillion in U.S. treasuries in 2013. By December 2025, $760 billion. They've sold $600 billion over 12 years. That's reduced demand for U.S. debt. Rates rise, prices fall. Foreigners in total held $8.5 trillion in treasuries. They're net sellers now. Domestic buyers are tapped out. So who buys the $4.5 trillion maturing in 26? Who? Trigger 5, commercial real estate. A $1.5 trillion in CRE loans mature between 2024 and 2027. Office vacancy rates are 20% plus in major cities. Property values down 30% to 50%. Banks can't refinance these loans at current valuations. Defaults are starting. New York Community Bancorp. Regional bank stress spreading. This spreads to the entire banking system like a virus. These aren't isolated events. They're happening simultaneously, right now. And they're hitting a system that's leveraged to the absolute maximum. The feedback loops are starting. Asset prices falling, collateral values dropping, margin calls increasing, forced selling accelerating, creating liquidity vanishing. Stage 3, verified, we are here now. Stage 4 is beginning. And here's why it will be worse than the Great Depression. Much worse. In 1929, debt was $290 billion. Today, 337 times more. In 1929, assets were mostly domestic. Today, globalized contagion is instant and worldwide. In 1929, derivatives didn't exist. Today, the $600 trillion in notional derivatives. Counterparty risk is systemic and hidden. In 1929, one asset class collapsed at stocks. Bonds and real estate held up initially. Today, stocks, bonds, and real estate are all in bubbles simultaneously. When one goes, they all go together. The dollar was backed by gold. It held value today, pure fiat. The dollar itself is at risk. In 1929, government debt was $16 billion manageable. Today, $36 trillion. Government can't bail out the system without destroying the currency. In 1929, there was no Fed put, no bailouts. The pain was concentrated and cleared quickly. Today, every attempt at bailouts and stimulus will make it worse by creating inflation on top of deflation. Stagflation, the worst of both worlds combined. The math is undeniable. If stocks fall 50% from current levels, that's $20 trillion in wealth destroyed. If real estate falls 35%, that's $18 trillion gone. If bond prices fall 20% as rates spike, another $5 trillion vanishes. If the dollar loses 30% purchasing power through inflation, every remaining asset loses 30% real value. Total wealth destruction could hit 60 to 80 trillion. That's 4 to 5 times the Great Depression in nominal terms. Worse in real terms when you account for how interconnected and leveraged the system has become. Now, here's where people object. Let me destroy these arguments one by one. First, the Fed will save us. Wrong. Dead wrong. The Fed's tools are broken. They can lower rates. That creates inflation and destroys the currency. They can print money. Same result. They can do nothing. Markets collapse. There's no good option left. The debt is too large. The bubbles are too big. Every intervention makes it worse long term. 1929 had no Fed intervention. The pain lasted 4 years, then recovered. Japan tried every intervention for 30 years. Still hasn't recovered fully. You cannot print your way out of a debt crisis. You can only transfer the pain from defaults to inflation. Either way, wealth is destroyed. Someone pays. Second, the economy is strong. Employment is high. GDP is growing. This is backward-looking data. It tells you where we've been, not where we're going. The stock market peaks before recession. Housing peaks before recession. Employment peaks before recession. We're at the peak right now. Unemployment was 3.5% on October 9, 2029. 4 months later, crisis. GDP growth was strong in 2007. Crisis hit 2008. Current data tells you nothing about what's coming. The triggers I showed you, those are forward-looking. And they're all flashing red. Every single one. Third, this time is different. We have better technology, better policy tools, smarter central bankers. No, this time is not different. This time is worse. More debt, more leverage, more complexity, more interconnection. All of that makes the system more fragile, not less. Every empire that ever existed believed it was the exception. Rome thought so. Spain thought so. Britain thought so. All collapsed under debt. The pattern doesn't care about your technology, it cares about mathematics. Debt growing faster than output always ends the same way, always without exception. Fourth, asset prices can't fall that much. The Fed won't allow it. Watch them try, just watch. The Fed cannot control a global deleveraging event. When margin calls hit, when banks demand cash, when foreign sellers dump assets, the Fed is helpless. They learned this in 2008. They bought $4 trillion in assets, delayed the crisis 12 years. Now the bubble is 3 times larger. They'll try again. It won't work. The leverage is too extreme. The bubbles are too widespread. The debt can't be sustained. Math wins. Policy loses. Every time. So what does this mean for you? 3 critical actions before stage 4 accelerates further. First, understand the mechanism. Really understand it. Debt crises follow predictable patterns. We are in stage 3 heading into stage 4 right now. Asset prices will fall. Debt will default or inflate away. Wealth will transfer from paper holders to hard asset holders. This is not a maybe. This is not a possibility. This is mathematical certainty. Position accordingly. Second, reduce exposure to inflated assets. If you're heavily allocated to stocks at all time highs, you're holding the bag. If you're in bonds with rates rising and deficits exploding, you're going to get destroyed by inflation or default. If you're in real estate bought at peak prices with leverage, you're facing negative equity when prices fall. The preservation move is into hard assets that survive currency destruction. Physical gold, physical silver. Productive assets generating real cash flow. Commodities with actual utility. These don't guarantee profit, but they provide protection when paper burns. Third, eliminate variable rate debt. In a crisis, rates spike unpredictably and fast. Variable rate mortgages, credit card debt, home equity lines. These will destroy you when rates jump and credit freezes. Fixed rate debt is manageable. You know the payment. Variable rate debt is Russian roulette. Pay it off now. Reduce leverage before the system forces you to liquidate at the worst possible time. The Great Depression destroyed $17 trillion in today's dollars over 4 years. 2026 would destroy $60 trillion or more in 18 months. Not because I say so. Not because I'm predicting it. Because the debt levels are 49 times higher. The leverage is extreme. The bubbles are synchronized. The triggers are hitting now. All at once. And the pattern has never been broken in human history. Not once. Subscribe if you want to understand what comes next. Because in the next video, I'm going to show you the exact timeline for stage 4 month by month. What breaks first? Which assets collapse when? When the liquidity crisis